What's up, guys? So this video is going to be about what happened with GameStop, what could possibly happen with BlackBerry and Express, thinking of all the meme stocks off the top of my head. And we'll talk a little bit about the economy and where we might be headed by summer's time, right? We have a pretty big week with earnings coming out this week. I know Apple's reporting, I think Tesla is too. So you see me post earlier today about what an option is. It's a right but not an obligation to purchase or sell stock at a certain price. And if you're selling it, it's the opposite. It is the obligation of you to either purchase a stock or sell a stock at a certain price. So in English, what the hell does that mean? You're like, oh man, this guy, it's just a little bit hard to wrap your head around it at first because it's new. Anything new is going to be weird, right? And guys, remember, the key here is like anyone can learn business, anyone can learn stocks. It's just learning the language first, right? Once you learn the language, then everything just kind of flows. So I'm going to break it down very simple, and then we'll walk through what happened, or as simple as I can make it. I'm going to try to make it like if I was talking to you, no offense, but if you were like maybe 8 or 10 year old, okay, that's what I'm trying to do with this video. Hopefully it works. So options are a contract. Okay, one contract is worth 100 shares. So we'll go over that. So one contract, 100 shares. Now, there's only four things you could do with an option. You could buy a call, you could buy a put, you could sell a put, or you could buy a call. Now, with these four things, there's a bunch of other things you could do. You could do like spreads and this and that. But for this purpose, we only need to understand these four things, okay? So what do I use to remember it? I did this a lot when I was learning because I'm pretty stupid. So it takes me a long time to learn something, okay? It does. Like, I learn very, very fast on things that I really, really give a shit about, right? Like if I really care about this, like if it can make me money or if it's like very cool or interesting, I'm like all ears and I just grasp that concept. But some things that I have, things that like I struggle with, like science or whatever, it takes me 2-3 times to learn, and I got to come up with little like acronyms or little tricks to figure it out, right? And even me with the four things I mentioned earlier, I was having a hard time when I first started learning about options. I was like, oh man, this is confusing. So the best way I could describe it to you as someone who absolutely knows nothing, all you know is, oh, you buy stock low, you sell stock high, right? A call option, it means you're calling it. It's going up, right? A put option means put it down. It's going down. That's easy. So just remember that. Call is you're calling it. It's going up. And put is you're putting it down. And the same thing when you're selling it, when you're selling it, it's the opposite. When you want to sell a call, you think that it's not going to go that up. So it's like, yeah, I'll sell you the hype, right? And then when you want to sell a put, it's like you don't think it's going to go down either. So it's like in between. So when you sell a put, you're telling somebody, hey, I'll buy the stock at this price. And you're just, as long as it never reaches that, you make money. When you sell a call, it's like, hey, I'll sell you this stock at this price. And if it never reaches that price, you keep that money that you collected for selling it. And for buying a call, it's just a straight line. Only amount of money you could lose is the money you put up. So if you say, hey, company XYZ is trading at, let's say, $10, and company XYZ, and you think company XYZ by February 12th, Friday, February 12th, is going to go to $15, and you buy a call, okay, so you might pay $1 for that call, and dollar times, it's one contract, right? So it's 100. So $1 times 100 is $100. So you buy a $15 call option. That means that you need XYZ company by February 12th to go to $16, right? Because it's 15 plus you paid the dollar, so you got to make that back 16. So anything after 16, you get to keep. And then a put option, let's say you thought, oh no, company XYZ is going to go to $5. So then you buy a put, and then if the stock goes down to $5, actually you need to go to 4, right? Because if you buy a $5 put and you paid $1 for it, then you would have to go to $4, right? Because you got to collect your dollar back. And anything under 4, from 4 to 0, you'll make your money. So it goes a little bit more deeper, but I only have so much time. But I need you to understand just that very basic principle. And you could probably rewind this and redo it. And if I messed it up or I still confused you, I'm sorry. But really hit YouTube, hit Investopedia.com, and they'll go a lot deeper and a lot more in depth for you to understand it. But so once we understand these principles, I'll explain what happened with GameStop now. So GameStop, basically, there was a lot of short interest. So roughly there's like 71 point something million shares. We'll just, for easy numbers, we're going to say there's 70 million shares of GameStop out there. And over the years, for the last like Sorry, excuse me. Over the years, hedge funds have just shorted it because it's unfortunately a dying business. We all know you don't even have to be a video gamer to understand that. You have cousins, friends that play video games, and you start to quickly realize that we're not going to GameStop anymore to trade in games. We're just kind of buying them digitally, and whatnot. So what happens is when you short a stock, you basically, and like I've also posted about this, I'm explaining this as if you didn't see any of those posts where Bill Ackman explained it. It's like, let's say let's say that your buddy owned some coins, and the coins were worth $100, but you think those coins are worth 50. So you tell your buddy, hey, can I borrow your coins? And your buddy says, yeah, sure. You borrow those coins, and then you wait for the coins to go down in value. You borrow those coins and you sell the coins immediately, and you tell your buddy, hey, don't worry, I will give you back your coins. You sell them immediately, you collect that $100. And then let's say you were right, like a couple months later, whatever time you want to put, the coins go to $50. Then you buy those coins back. You collect, out of the 100, you give 50 for the coin, you keep 50, and then you give your buddy your coins back, and now you made a $50 profit. That's what a short is, and that's what these guys were doing to GameStop. These hedge fund managers were doing to GameStop. Like GameStop was at like $10 or $20, so they would borrow the shares of GameStop, right? And then they would immediately sell them on the market. They would pocket that $20 or $10, and as GameStop shares started going down, they would repurchase those GameStop shares and give them back to the person they borrowed it from, and they would keep the difference. And it was a nice little racket they had going for a while, as they would buy it at the top, short it down, then buy it up. But the problem is when you have a stock like GameStop that only has 70 million shares, you have a situation which is called the low float. Okay, so a low float rate means, not all 70 million shares are going to be traded every day. A lot of institutions own GameStop. A lot of individual investors own GameStop. So the stocks that are out there that are buying and sold every day, that's what's called a float. So the dudes over at Reddit figured this out, and they also figured out that Michael Berry, the guy with The Big Short, the movie. If you haven't watched that movie, watch it. It's freaking amazing. It explains the 2008 housing crisis. Believed that GameStop was really undervalued, and guys, it was at $2. It was really undervalued because even though the business is dying, like Warren Buffett did in his early days, it doesn't mean the business isn't making money. And you saw the PlayStation was coming out. You saw the Xbox was coming out. Maybe Nintendo's coming out pretty soon too with something else. They were going to make some money in the next few years, even if the company dies. But it had, $400 or $500 million in cash. It had like $400 million in cash on hand. And it was only valued at $2 billion or roughly, or no, less than $1 billion at the time. And so I was like, okay, well then I'm going to get, they had $400 million in the bank, and it's valued at only $1 billion, but they're also going to make money off of selling Xboxes. In the meantime, hey, I can make some money by holding this for the next 5 years. It's a pretty damn good bet that even when the company goes bankrupt, they're still going to have cash on hand to pay you out. So at $2, it was a great bet. So then you had Michael Berry buy up a nice little chunk of that. Then you had the owner of, or the co-founder, of Chewy, also said, you know what? This could be a great turnaround story. They could start selling PCs. They could maybe start selling collectible cards. I mean, they have this infrastructure. They have this network already there. So maybe they're not selling games, but they'll be selling something else. They have the retail space. I see value. Let me buy some. So what happens is when you're buying in the open like that, of course, you're taking away from the floats, the shares that are out there in the public being bought and sold every day. And you're taking some shares on the institution. But it got to a point on December 31st, 2020, a day that will never be forgotten, that will live in infamy. It was shorted over 100%. So that means that there's only 70 million shares available, but there were 70 million shares short. So it's like, how is that possible? It's, financial engineering. Those dudes over at, Wall Street Bets on Reddit figured this out. They were like, wait a minute, hold up. These dudes, if this stock price starts going up, right? Like if it goes from $2 to $10, those guys need to buy back those shares. Remember the coin example. If you borrowed a buddy, if it was me or you, and we borrowed some coins from our buddy and we sold them, if the coin was worth 100 and we sold the coin and we're thinking the coin's going to go down to 50 and we thought that, we could buy back this coin, at 50 and then, give our friend his coin back and keep 50 in profit. But all of a sudden, if that coin ends up being worth $1,000 and we only have 100 in cash, we're going to be like, holy shit, we need to buy this coin before it goes to $2,000. And then the risk when you're shorting is infinite. Okay? So what happened was you had a low float rate. You had a lot of people short that stock, and there wasn't that much of that stock available to buy back at once, right? And then these dudes bought all kinds of call options, right? So they said, you have to give me the shares at this price. Okay, so then people that were selling the call options were writing the call options saying, yeah, I'll give you GameStop at $20 and it was trading at 10. They never thought it was going to get to 20. Or when it was at 20, they were like, yeah, we'll sell call options at 30. It's never going to get to 30 because that's like a freaking, 50% increase, right? So you had all these dudes load up on these call options. It was a very low flow, and a bunch of people were short the stock. So this thing is what you call a squeeze, and it is squeezed. That's what happened. It's like you had the pressure from the people that wanted to buy the stock back, right? Because they were losing so much money being shorted. You had the pressure of people wanting to buy the shares to cover their call options. That was being shorted. Then you had just regular people just trying to buy the GameStop stock because it was just regularly going up. So it's like everybody is fighting for only 70 million shares. And out of those 70 million, there's a large percentage number where real investors were holding the stock because they're like, no, we actually believe in the company. We're not going to sell it, right? So then you had all these people chasing this stock, and there's only so much of that stock. So, of course, the freaking stock just ripped up and has skyrocketed, right? So now any hedge fund manager that had major exposure to it that was shorting it at like $20 now had to go back and start buying those shares back. And then when you have the call option writers buying those shares back, when you had the hedge fund managers that were shorting it buying it back, as you could see, there was a lot of demand for the stock and the supply of the stock was low. So it just kept going up. Hey, you want it? You got to pay me this much for it. And then so if you didn't pay it, then the next person would. And then you'd have to come back and buy it at a higher price. As you can see, it just kind of got higher and higher and higher and higher and higher. And so that's what happened is retail figured out that if there's this much of we could artificially create the demand for the stock by buying a shitload of call options, buying up some of the stock, and forcing the people that were shorting it to buy it at a higher price. And then therefore the call option went up. So then those people had to buy it, and it just a self-fulfilling prophecy. And then people want to get mad at retail, but guys, this is exactly what happened to SoftBank. This is exactly what SoftBank did literally in August when they crashed the market. When the market went down like 5-6%, they were just doing it with big tech. So it's okay for big guys to do it, but not for the retail guys. I was so happy that the retail guys crushed these guys, and that's what happened. They got crushed. They got greedy and they got caught. It was just like a perfect scenario. Now, had there been like 700 million shares of GameStop and not 70, it'd be a lot harder to do this. So the people that are doing this now with Express, they're trying to do the same thing with Express. They're trying to do the same thing with BlackBerry, but BlackBerry has 500 million shares. And also, I forgot about it, AMC, right? AMC is going through the same thing right now too. So retail is becoming really, really strong. And I hope this kind of made sense to you guys exactly what happened to GameStop. And, for AMC's purposes, it's crazy because people are literally saving the company because AMC is issuing another 100 million shares. So they're adding more shares, but they're going to be the company selling it, and they're selling it throughout periodically. So right now, if GameStop or AMC goes to $5 or $6, AMC is selling those shares. They're going to collect that cash. If they were to sell all 100 million shares for $6, $600 million in cash that they're going to get, and they're going to be able to stay alive. And it's really up to people like me and you to keep buying AMC if we believe in it. Like, yeah, we'll buy it. We'll keep it alive. Then AMC will live. So it's just an amazing time because I think finally the regular retailer now has the respect of Wall Street, right? GameStop went from $1 billion to $7 billion in market cap. That means $6 billion in losses to Wall Street. And now maybe that's still pennies to them, but retail's on the map now. You can't just brush us aside. And I don't know, maybe there'll be regulation coming. Maybe they'll say some stuff like you can't buy options unless you have the money to buy the strike. I mean, it's a very interesting time, but then again, it's a free market and you shouldn't be making bets if you're not willing to cover. So it was just an amazing week. And for an investor and everybody on the Reddit boards for Wall Street Bets, everyone's having the time of their life. I would just say, be a little bit cautious. Capital is very, very hard to earn, and it's very, very easy to destroy. Just remember that. Very hard to earn, very easy to destroy. So please trade with caution. Please do your homework and don't just follow anybody, especially someone like me or anyone like me. do your own homework, and get financial help before you make a decision.